When you're looking at that maximum house payment, it is not just principal and interest. You need to also estimate for property taxes, hazard or fire insurance, mortgage insurance, homeowner association fees, flood insurance, any other kinds of expenses. So on a DTI, what you're going to look at is, let's just take Maricopa County and Phoenix, Arizona as an example. Okay, so we have a PITI of 2245, and then we have 0.32 for fire insurance, 0.87 for property taxes. And so with our principal and interest, you're going to add fire insurance and taxes, and that's where the PITI comes from. So our 2245 principal, interest, taxes, insurance is made up of four numbers: principal, interest, the insurance, the hazard insurance, that factor of 0.32, plus taxes with a factor of 0.87, all of this on a sales price. All right, Dave, this is now determining our payment, but don't we have a sales price? Yes. And don't we have a down payment? Yes. Again, depending on the program. Some programs don't have down payments, USDA and VA for examples. So let's use a 5% interest rate for this example. And let's just start putting in numbers here. So for your lending area, you're going to need to identify the insurance and property tax factors to use. We're just using Arizona as an example. You're going to use the sales price or appraised value with those factors. The amount will adjust when actual expenses are known, so these are just placeholders. But using a slightly higher amount gives a little bit of wiggle room for you to figure things out. If you don't know the sales price at, early in the stage, you can just use an estimated sales price, you guess. So for this payment range, let's start off with $350,000 as a sales price. The borrower is putting down $50,000, which is not 20%, so they will have MI. Let's figure this out. Sales price, $350,000 times 0.32 for our insurances equals $1,120 for an insurance premium for a year. Let's divide it by 12 to figure out how much we're going to increase our principal and interest to take care of taxes and insurance. We're just talking about insurance, so this will be $93. The 1120 divided by 12, $93. Cool. Now let's figure out taxes. Take your same $350,000, multiply it by 0.87%. That adds up to $3,045. Well, $3,045 is not what they pay monthly, so you're going to divide it by 12, and you're going to come up with a number of $254 for monthly property taxes. Take the $350,000 times 0.65 because the down payment, remember, was not enough to eliminate mortgage insurance. So let's say 0.65 is a mortgage insurance factor, $2,275 per year divided by 12 equals $190 for monthly mortgage insurance. Now it's estimated that based on the down payment, based on FICO scores. There's a couple of different factors. This is not an MI class, nor are you going to be tested on mortgage insurance in the exam. But for determining a housing ratio, let's now take all of the numbers together. So we have the 2245, which was our total based on our ratios, minus $93 for our hazard insurance, minus $254 for taxes, minus $190 for monthly mortgage insurance, leaves us $1,708 for our principal and interest payment. Now, we're doing this slow that you can do with a pencil and paper. You don't necessarily have to do that in this day and age because we have loan origination systems, LOSs, that will calculate these things for you. You can do it with a financial calculator if you have one. So again, $1,708, hit the payment button. Enter the interest rate of 5%, then hit the button labeled I for interest. Next, the term of the loan, you can either do it in months or years, 360 months, or N, meaning number of payments, or term of 30 years. Next, hit the compute button, then present value, and it will give you the amount that the person should, the loan amount that the person should qualify for. So there's a lot of different ways you can do this with a calculator, a handheld calculator. There's also software, for your phone that you can plug this in, and all you're trying to do is reverse calculate. If I have this kind of a payment, what kind of a loan amount is it? So that's all you're trying to do. So if you're going from loan amount to come up with payment or payment to determine loan amount, just remember, you need 3 to come up with the 4th factor. So let's do a really, really quick repeat. So if you have the balance, and then you have the term, and then you have the interest rate, you can determine payment. You can go backward. If you have the payment, and you have the interest rate, and you have the term, you can plug those in to determine present value or loan amount. So if you are pretty much in any kind of a situation, calculator, phone software, tablet, laptop, you can do it one way, the other way, it doesn't matter, okay? We always work with loan amounts. So you'll also need to make sure that you take into account the down payment, which will affect your loan amount. Now, again, practicing these calculations, it's useful, especially when you're with new home buyers, or maybe your loan origination system is down, or you don't have a good internet connection, or you don't really have a calculator, but you always have your phone, and you jump online and you do a Google for some sort of a financial calculator. I'm just trying to let you know that you can do this on your own. You don't need to have your computer all the time. You should relatively soon, wherever it is that you're practicing, figure out MI factors, tax factors, and insurance factors, so that when you guesstimate, you're really pretty close to being right on. I gave you the examples of Arizona. I happen to practice in other states, and so those factors might be a little higher than what I'm used to. However, being a little bit higher is not a bad thing to overestimate, and so you're not coming in right at the max. You're coming in a little conservative. And generally speaking, we love realtors, but generally speaking, realtors will try to push that purchase price a little higher. The down payment didn't change, right? Because the borrower only has that amount of money. And so the numbers will be pushed a little higher. So it's not bad to have a little bit of cushion in there when you're doing these calculations.